Is gold still the safe bet it used to be? Or is it just shiny nostalgia for old-school investors? Today, we'll reveal the truth about gold and how the wealthy really use it to build and protect their fortunes.
Stay until the end for a bonus strategy: how to use AI to rebalance your gold and stock portfolio automatically.
Fear versus facts. Let's separate both.
And keep your decisions disciplined, not emotional.
First, why people still love gold.
For thousands of years, gold has held a place of immense importance in human civilization. Kings, emperors, global traders. Today, in a world of digital transactions, many continue the tradition. They turn to gold when the future feels uncertain, when the cost of living rises relentlessly, and when geopolitics become unstable. Gold serves as an anchor in stormy economic seas. It doesn't rust, tarnish, or corrode. Value that endures. All the gold ever mined would fit in just a few Olympic-sized pools. When currencies weaken, gold often rises in those terms. As Ray Dalio put it, if you don't own gold, you know neither history nor economics. Endorsements reinforce gold as a component of diversification. Belief begets demand, which begets price, a self-reinforcing loop. In an intangible world, tangible value is reassuring. Individuals, institutions, even governments keep gold as a backstop of value. Gold doesn't generate income, it preserves, not multiplies. Unlike other assets, it produces no cash flow. Stocks can pay dividends, bonds pay interest, real estate can pay rent. Hold an ounce today, you'll still have an ounce a year from now, unless price changes. Gold can be volatile. It sometimes jumps quickly, and sometimes stagnates for years. Think peaks and valleys, not a smooth climb. Versus stocks, long-term total returns favor a diversified equity index like the S&P 500. Businesses innovate and grow profits over time. Gold's price is driven by supply, demand, and sentiment. It preserves in certain conditions, but it's not the best engine of long-term growth. Use gold for defense, not offense. It's a shield, not a sword. It reduces volatility and hedges crises like currency devaluation and high inflation. Don't expect gold to drive portfolio growth. Understand the role, and you'll avoid unrealistic expectations. The wealthy use gold differently than the public, not to get rich quick, but as a preservation tool. They keep the allocation meaningful but modest, typically 5 to 10%. It cushions downturns, without dragging returns in good times. Hedge funds, large institutions, pension funds and endowments, they diversify across stocks and bonds. Gold helps balance those risks. Non-correlation is the mathematical reason it stabilizes a portfolio. Beyond numbers, gold provides emotional insurance. A tangible asset with millennia of stability can steady nerves. That calm helps avoid fear-driven mistakes. Sleeping well during a crisis has real value. Key takeaway: moderation and purpose. Use it systematically and unemotionally as permanent insurance. Protect against the worst so other assets can pursue long-term growth. Modern investors can own gold physically, via ETFs, or through mining stocks. Each path has different trade-offs. Physical gold offers direct tangible ownership, security independent of financial systems, but storage and insurance are on you. Higher transaction frictions, and less convenience. ETFs track the gold price, trade instantly, and stay low cost. They hold bars in audited vaults, but charge a small annual fee. Mining stocks can amplify gains if gold rises. And some pay dividends. But you take on management, operational, and political risks. Mining stocks are inherently more volatile than gold itself. AI now automates portfolio defense and rebalancing. Systems monitor markets 24/7 and adjust allocations by rules. They can increase gold during volatility and trim it when conditions ease. Platforms like Betterment, Wealthfront, Titan, and QAI offer automated tools to the public. Automated rebalancing enforces discipline: 60% stocks, 30% bonds, 10% gold, maintained without emotion. The hedge conversation now includes crypto and AI equities. Gold versus crypto versus AI, different roles. Bitcoin is often called digital gold, with fixed supply and no central control, but its volatility far exceeds gold, and regulation remains fluid. AI leaders can deliver growth, grow and carry growth risks. Sophisticated portfolios combine complementary roles. Gold stays defensive, stability and systemic hedge. AI stocks are offensive, aimed at long-term appreciation. Crypto is more speculative. Persian size, size accordingly. A balanced plan, small core gold, larger growth stocks, optional tiny crypto. Gold may not make you rich, but it keeps you rich.
The smartest investors know gold isn't about fear, it's about balance.
Diversify, automate, and protect your wealth. Don't forget to like, comment, and subscribe for more AI, finance, and wealth building tips.
See description for resources and tools mentioned.